Hey guys, Jim Terrell here with Plentiful Wealth. Today I want to talk about the boogeyman in the room, and that's inflation. I know you've probably heard about January's inflation numbers, 7.5%. That's crazy. If you're like me, you realize food costs more, gasoline costs more, housing is costing more right now. Prices are going up all over the place. And you're probably wondering, how is that going to affect me, and what can I do about it? And if you've looked at the stock market over the last few days, you've also realized stock market's gotten hit pretty hard. What do I need to do there? So let's start off and talk about what inflation really is. I can give you the book definition, but in reality, that doesn't matter. Inflation just means you're going to pay more for everything that you buy. The carton of eggs that had been $2 might be $2.50 or $3 now. Or the loaf of bread, it's going to cost more. Now, I paid $4 a gallon for diesel earlier this week. All this comes down to the fact that you're going to pay more for your everyday necessities in life. Pretty simple. We all pretty much get that. So let's talk about what affects that, what causes inflation. And I'm going to get a little nerdy here. I know that's what I do here. And I want to show you a graph. So what this is this is a supply and demand chart. It's just a graph showing the number of goods, amount of goods over here on the bottom. And then over here on the vertical axis is price. So I've got the supply curve here and the demand curve here. And this is how we can really model inflation. It's pretty straightforward. So what happens is inflation can be caused in two different ways. It can be caused by lowering the supply, which is what's happening right now. We've had an issue since COVID hit, that supply chains have broken down and we're not getting all the same goods that we were getting 3 years ago. So that's really hurt people, and it means that we don't have as much to buy. So more money is chasing fewer goods. So that's modeled on the supply side. The other side is the demand side. And on the demand side, that's just saying, if I went from making $50,000 a year to $80,000 a year, for instance, it means I have an extra $30,000 to spend. I'm going to go spend that money on extra goods. So demand is going to go up. So to show that visually, I'm going to draw an extra line here. It's D1, it's D2. So what you're looking at is equilibrium price, which is where these cross. So initially, you're right here. So the price is here. If the demand moves up, the equilibrium price goes up, and you move from this price to this price, and that's inflation. The other thing that can happen, I want to show you two different supply curves. Supply one, supply two. So this is what's actually happened over the last year or so. You've got supply one, where we start out here. As supply goes down, because people can't find goods, because goods are being stuck in ports, and they're stuck on ships floating around outside of Los Angeles Bay. Supply goes down, so the supply curve moves to the left. So you go from here to here. So it's the exact same thing. Price goes from basically right here up to about here. And this right there is inflation, and that's what we're seeing. So this brings us to what's going to happen next. And if you've been watching any of the news, you've probably heard that the Fed is probably going to increase interest rates. What does that do, and how does that affect inflation? Well, it's pretty straightforward. When you put more money into the system, your demand goes up, causes prices to go up. If you increase interest rates, people aren't going to borrow as much because it's going to cost them more. They're going to have better opportunities by leaving their money in savings accounts than by investing it or by buying. So that's going to cause your demand curve to move over here to the left. Theoretically, that should push consumption down. When you push consumption down, that should also push down prices. Problem is, and this is what the Fed is really going to run into over the next few months, really, they're going to be really careful about raising interest rates. Because if they raise too fast or too high, they can create a recession, and they really don't want to do that. So while right now, especially with January's inflation numbers, people were pricing in a 0.5% increase in interest rates. It's going to be tough, and we really want to make sure that they don't push too hard and push the actual amount of goods required down too far, because that's going to hurt all of us. So frankly, on my own behalf, I'm kind of worried that they're going to push too high. Some places are estimating 5 or even 6 interest rate hikes over the next year, and that's a lot, especially when, like we talked about, it wasn't a demand reason why we have inflation right now. It's a supply reason. And as supply chains open back up, as COVID starts to die down, I'm going to cross my fingers on that one, because I hope to God that it does. And I think it's going to. Naturally, the supply chain should react and should be able to shift back to the right and push prices down. That should happen naturally. The problem is the Fed is they're kind of stuck between a rock and a hard place right now, because people don't like paying higher prices. The Fed has a mandate to keep inflation under control. They also have to keep jobs high, or unemployment low, whichever you want to go with. And so they always try to balance that. In this case, they don't want to be seen as doing too little and allowing the market to go, or the economy to go way, way too high. But they're stuck between the rock and the hard place, because if they do too much, it could put us in a bad place just because of that. So what can you do to protect yourself right now is probably the question you're thinking. Because while I can talk about this all day, in reality, we can't control this. You, me, it's out of our control. What you can do though is look at value stocks. They've been out of favor for the last 10 years, kind of boring, big dividend stocks. But as interest rates rise, value stocks tend to outperform growth stocks. And I've talked about that in a previous video. I won't go into that right now, but just know, typically value stocks outperform growth stocks during a rising interest rate environment. Another thing you can do is shorten the duration on your bonds. If you have bonds in your portfolio, make sure that you're not taking a whole lot of duration risk, because if a bond has a 10-year maturity, it's going to get hit harder by a 25, 50, 1% interest rate rise than if it was a 2-year bond or a 6-month bond. So take that into account. And then finally, if you have any kind of adjustable rate interest, whether it's a mortgage, maybe you have a 5 to 7 year ARM, if you have adjustable rate student loans, anything like that, this is a good time to go ahead and either refinance or lock into a fixed rate, because you don't want to get hit with rising interest rates, especially if they rise too quickly. So I know I've covered a lot today. I'm not going to go into anything else right now, but if you have any questions, drop them in the comments, shoot me an email, jeb@plentifulwealth.com, or as always, you can always schedule a call with me at plentifulwealth.com. There's a button in the top right. Thanks.